I hate to say this, there might actually be 4 videos today. I'm going through my inbox. I'm like, it's not that important. I really don't want to talk about that. Not that big of a deal. Can it? But I'm like, gosh, I want to talk about all the stuff I sent myself today. So I'm like, it'll be a call to Friday bonus. All right? Friday freaking bonus. Throw you a freaking bonus. Why Albert Edwards, expects an imminent bond market bloodbath. It's 1994 all over again, he says. This article's from Zero Hedge. Following the Trump presidency victory, 2 prominent macro strategists have undergone a significant change in their outlook. While David Rosenberg, who started off with a deflationary and bearish outlook, then flipped to inflationary and bullish, has recently once more mean reverted and expects a further drop in yields as deflationary forces return. His Societe Generale peer, Albert Edwards, while still expecting a deflationary ice age in the longer term or longer run, in case there is any confusion, he expressly states, "Make no mistake, unlike most in the markets, I remain a secular bond bull and do not think this 35-year-long bull market is over." Now expects an imminent bond rout in the coming weeks as the Fed's rate hike cycle leads to an aggressive sell-off in short as well as long-term rates. The result will be another central bank-inspired recession. You may know it as the boom and bust cycle, or more properly termed, the business cycle, which will lead to the convergence of yields on the 10-year U.S. Treasury with Japanese and European bonds below zero as the global deflationary ice age enters the final round. And you've been watching silver and gold lately? Even Bitcoin got a little bit of a smackdown. Especially, I just looked a minute ago, silver was $16.98. So it went from 1820 or so, whatever, right? 18 something, down into the 17s and touched 1698. Gold, they're trying to get it back under 1200. Why are they doing that? Well, as I mentioned the other day, I've said this a few times, just been a while. If you know you're the club and you know, as in a mathematical certainty, mostly because you're the one holding the price down and you've got this feeble economy held by pieces, and you know that when you can't hold on to it any longer, gold and silver are going to absolutely explode. As I mentioned, yesterday's video, one of them. You don't let the price rise. Let's get silver in the 20s and 30s, and let's get gold to 1500, and then have the prices, and then they skyrocket from there. No. You want to keep those depressed as far down as possible, so that when they start to do a nice little rocket ship up, oh, silver's back to $25. Whoa! Oh, yeah, it's at 16. If it was already at 25 and then it went to 35, well, you're going to really cause a rush in there. They don't want people touching it right now. They want to scare you away every time you think, you even look over this way at the price of gold and silver and expect it to go higher, you're going to get slammed. And people, boom, slammed. 18, we're back over 18. That's a critical number, though. The technical markets, 200 day moving average says, never mind, they crashed it. Which is why I say don't look at the charts. They're meaningless. Yeah, but the fundamentals, doesn't matter. The fundamentals exist. They're there. And ultimately, that's what's going to prevail and push the price up. But they have no effect right now when the prices of gold and silver are set with a piece of paper being liquidated to the tunes of tens of thousands, each for 5,000 ounces of silver at a little snap of someone's finger. But each time they do that, it's becoming more obvious. And like I read the other day, I think was it Big Sweer was talking about it maybe, that it was, as of last year, from the previous year, it cost 41% more dollars paper to move the paper market. They had to throw 41% more money to move the price around. That's a big increase. Edwards' summary of his current state of mind, just as the Fed is about to make yet another historic mistake, is, as usual, rather picturesque. He says, make no mistake, unlike most in the markets, I remain a secular bond bull, and do not think this 35-year-long bull bond market is over. I believe the U.S. Fed has created another massive credit bubble that will, when it bursts, lay the global economy very low indeed. Combine this with the problems of a Chinese economy dependent on increasingly effective injections of credit to produce increasingly pedestrian GDP growth, and you have a right global mess. Now, let me stop. What did my previous video just talk about? It takes $4 of new debt creation to give us one little piddly dollar of GDP growth in America. Again, this doesn't end well. He says the 2007 and 8 global financial crisis will look like a soft landing when the Fed blows this sucker sky high. The seeds for that debacle have already been sown, with the Fed having presided over one of the biggest corporate credit bubbles in U.S. history. All that is needed now is for the Fed to sprinkle life-giving rate hikes onto these as yet dormant seeds of destruction. Accelerated Fed rate hikes will cause tremors in the Treasury bond markets, forcing rates up, most especially in the 2-year, just like 1994. But as yet another central bank-inspired global recession unfolds, I believe that U.S. 10-year bond yields will ultimately converge with Japanese and European yields well below zero. In other words, buy 10-year bonds on weakness. And speaking of 1994, and the reason why Edwards is confident that despite the market pricing in the Fed's upcoming rate hikes, nobody has a clue what is about to be unleashed, the Societe Generale strategist reminds his clients of the Orange County havoc unleashed with the 1994 rate hike cycles. And he says, for those few of us in the markets of a certain age, Orange County conjures up only one thing. 1994 goes down in infamy as one of the biggest ever bond market bloodbaths in history, culminating at the end of the year with Orange County in California going bankrupt. And he says younger clients in their late 20s will only know Orange County or the OC as the mid-2000s teen program based in Newport Beach, which I watched religiously with my then teenage son and daughter. I remember the 1994 period as if it were yesterday, unlike yesterday itself. Despite the Fed telegraphing the series of rate hikes and market participants forecasting multiple rate hikes, it was most curious how the market went into total convulsion. I was chatting to my similarly long colleague, Kit Jukes, about this, and he reminded me that the whole yield curve gapped up some 50 basis points immediately, so 0.5%. It was a bloodbath, especially for 2-year paper. For the benefit of readers who may have missed this particular episode in bond market history, Edwards here are some more details of how the 1993 to 1995 rate hike cycle flowed through the bond market and then promptly resulted in an inverted curve. He says you really had to be there at the end of 1993 to understand just how widely expected the 4 February 25 basis point Fed rate hike was. I guess he means February 4th. I was at Cleanworth Benson back then, and I remember articulating that rates could rise somewhere more than the market expected on our December 1993 macro European tour. There was no real pushback. I have managed to lose my global strategy weekly files from that time to see exactly what I was saying then, but I have my yellowing press cuttings file from the Financial Times on 8th February 1994. I find this. Quote, on Thursday, the day before the Fed's first hike, Mr. Albert Edwards of Cleanworth Benson wrote, in the U.S., Alan Greenspan could not have been clearer. He regards 3% as an excessively low rate, which has served its purpose to eliminate the banking crisis and alleviate the credit crunch. The Fed does not care what headline inflation is. Rates are heading higher. The risk is that the markets do not view a 0.25% rate increase in isolation, but the first in a series of tightenings, which it will be. End quote. I was not alone in that view. It was quite common on the sell side. We thought we could not What though we could not anticipate was quite how savage the bond sell-off would be. Additionally, Edwards also shares 2 articles from that year. First from Fortune entitled The Great Bond Massacre of 1994, and also from December when the New York Times analyzed events surrounding the most high-profile casualty of that year, namely Orange County. In a word, the problem was leverage. Now let's talk about that for a minute. Leverage. When you can, that's kind of like the old margin thing, right? When you use leverage. In literally like physics, you have, let's just say you have a lever and you move this one little, because of where the pivot point is, you move one little side over here, just a teeny tiny bit. Whoa, the other side goes way up. Leverage. Or if that side's already way up and you move this a little tick the other way, boom, it comes massively down. Leverage. He says, Fortune magazine wrote in 1994, just as in the U.S., European bond investors were operating on lots of leverage. That made them just as vulnerable when the margin calls started to come in. What was that movie recently? Wasn't there a movie called, or was that the old movie, Margin Call? The result, you had a snowballing liquidation completely out of proportion to the economic fundamentals. Both the U.S. and Europe had been overexploited by investors on margin. And again, leverage, margin. What is margin? Margin, give you an example, when I lost $3,500+ in a futures contract on an account I had online with Options Express, I bought a mini futures contract of silver. And as I've explained this story before, I was actually doing wheat before that. Wheat was going up. I made some money. It was doing well. I was playing with the fake accounts, the practice ones, and I was like, I can do this. I'll pull a bull O'Reilly. F it, I'll do it live. And I did it live. Put some money in the account, let's go. And then I heard a story in Egypt where people were killing each other in line because the cost of bread was going up and the government didn't have enough to hand out to everybody like they used to. And I felt bad. Like, am I contributing to this price rise by me playing this game right now? So being the old kind of person JSnip4 is, I don't feel right. Let me get out of that. Oh, silver. Let me try playing silver. And I've made a couple bucks on silver. Well, I guess it doesn't matter what commodity I'm in. If I just do what I'm doing, I can make a couple bucks. And then I got crushed by JP Morgan when they flooded the market. $20 down to 17, margin call, boom, done. So that 1,000-ounce contract, how much, let's say at $20 silver, 1,000 ounces, $20,000. But I'm playing with 1,000 ounces, not for $20,000. I'm leveraged or using margin, which means Mr. JSnip4 just put in 10% of that value plus a little maintenance fee, about $1,000 or so, $1,500, somewhere around there, $1,000, $1,500. Thus, my total was about $3,000 to play the game. And if silver went up $1, I just pulled in $1,000. Ooh, that's enticing. Now, silver wasn't moving that much back then. 10 cents, 15, 20 back. Okay. Put an order up. I made, $30, close out my order, $50, whatever. And then JP Morgan came in and crushed it. Massive sell, liquidation, Bear Stearns, all that crap happened. Boom, boom, boom. Oh my God, someone flooded the market with enormous amounts of contracts. It took $20 silver down to 17. Margin call, boom. Broker's calling me, getting an email. You're down negative in your account. You need to give us $500. The account's been liquidated, but we can only liquidate it at 16 such and such. I replied, excuse me, I had stops in place at like 10 cents under where it was at. I understand that, sir, but when the stops are triggered, if there's no buyers on the market, it keeps going down till there's buyers, and then we liquidate it. And the earliest convenience was at 16 something. Oh, I didn't know that. I didn't know that. I found out. So speaking of margin, you have how many people playing the bond market on margin? And if what he says is about to happen in the near future, because of the rate hikes, bond bloodbath, how many places are about to go bankrupt? And he says in here that essentially, somewhere in here, that Orange County went like bankrupt or something. That the county had to file for bankruptcy. Is that the last piece? It was excess leverage in the bond market culminating in 1994's bankruptcy of Orange County and also the Mexican peso crisis in that same time, in that month, due to dollar strength. Anyways, if he's right about this, and again, fundamentals, data, it's all there. It's all there. And the Fed, what are we going to do? We're going to come out rate hike. And we're only in March. They're ready to go for it in a few days. And they're going to do it again. And they said they're going to do it again. Now, I know they've been saying that all this time. And it's funny how now that Donald Trump's the president, okay, we're really, really ready now. So that when the financial bloodbaths and all kinds of different assets out there take effect, oh, Donald Trump, you're the one, you were at the helm. Obama was in there for 8 years and none of this happened under him. They're going to make him look bad. So, anyways, if you're into bonds, I'm telling you, I don't trust the market. I understand it went way up. If you're playing that game, and I know there's some of you playing it, you're playing with fire. You may get lucky, though. You may be the exception to the rule and say, I played that market, and I played on margin, leverage, and I made some, Jay Snitman, I made some good money. And I'll say, you know what? I'm proud of you. I'm happy for you. I am. I'm glad to see my peoples, my other citizen folk make some money. Great. But you're playing in a game that's rigged, and the controllers change it whenever they feel like it. That doesn't sound good. That's kind of like Russian roulette. Is it my turn? How many people went? How many bullets were in this gun? And they all pulled the... Don't know. Don't like playing that game. Anyways, I'm out. I got one more video to do. Take care.